All right, everybody, we're going to get this thing kicked off. We got most of you here, and we would like to welcome you to the 2024 Year in Review event. This is our annual thing that we do. We love doing this, spend a lot of time putting it together. In fact, we like to track current events as they happen during the year and really educate you, which is a big part of what the value that we try to provide you guys is educate you about all the things that matter to your money, to your finances, to your planning, to the markets. So with that, I'm going to be your host along with the wonderful Matt Callahan. And I apologize that you can't see Matt on the video. I'm really, really sorry about that. We will get that squared away for next time. But in any case, we're going to jump into all the things that impacted you from last year. So Matt, are you ready to go?
Yeah, I'm ready. And just before we jump in, I'm pretty sure that my video was broken last year too. And I promise everyone I'm not hiding. I promise you, I've got a nice jacket, a nice shirt, was ready to go. So,
You're not in trunks and a t-shirt, Matt?
right.
Oh gosh, yeah, no, I can affirm he's got it. He brought his best jacket for you guys. He's dressed to impress for sure. I'm so sorry about that. So, all right. Well, listen, thank you. We get such positive feedback about this event, and I know we appreciate having you join us, and it's really a pleasure to work with you. So, not only that, but we have such a wonderful team here now to support you, and we've got some new additions and some folks that have been here a long, long time. So just a great team, and just again a pleasure to work with all of you. One thing, as most of you know, we really spend a lot of time trying to educate and empower you about your finances, and we've got a YouTube channel. And if you haven't subscribed to the YouTube channel, go take a look at it. It's Seaside Wealth Management on the YouTube channel, and we are putting out really quality videos to educate you on everything that matters to your financial planning and your investments. So make sure that you like and subscribe the channel and forward it to share it with any friends that you know who might benefit as well. But new for this year, we have rolled out an Instagram page. And a few years ago, people were like, Insta what? And Instagram, it is now definitely the thing. And if you have grandkids and you want to stay in touch with your grandkids, you better learn about Instagram because that's where they're hanging out. It used to be text and cell phone and Facebook and stuff. Instagram is now the new thing. So definitely follow us on Instagram, follow us on LinkedIn, and we have a Facebook page as well. So get social with us. Again, the goal is we won't bombard you or bother you, but we're just putting out information that's going to be helpful. Um, so, with that, let's jump into the major themes that impacted us in 2024. We're going to take a look at what had the biggest impact on the economy, the markets, and your money. We're going to talk about things like inflation, still pesky and still persistent, although getting a little better. We're going to talk about interest rates. We're going to talk about the housing market. We're going to talk about major changes to Social Security. We're going to talk about the dominance of large US tech companies. We're going to talk about the impact of the election on your portfolio, as well as market volatility.
Yeah, so the hot topic from last year was inflation, and as myself and all of you, we felt it at the grocery store and every time we went to the gas stations.
Yeah. So here we are, 4 years into the decade, and we've already had more inflation in these 4 years than the entire 10 years before us. In other words, it has been a painful start to the 20s for sure.
The good news that is that the current rate of inflation is in line with the long-term inflation numbers that we've seen. So things are starting to look back and come back to normal.
Yeah, I mean, take a look. You see this huge spike in 2020 and 2021. That's really the inflation. But the good news is that it might be transitory, meaning that after that major spike, I think what happened was people were cooped up for a year with the pandemic in 2020. They went on a major spending spree. Everybody was just spending money everywhere. Being cooped up for a year, people just started spending like drunken sailors, and inflation shot up. So after aggressive and somewhat painful Federal Reserve action of really raising interest rates in a hurry, inflation has been slowly trending down, which is very, very nice to see. Um,
And
so
that's what this chart is saying here is that we're starting to see the more normalized average CPI of
right.
inflation.
Yeah, yeah. Thank goodness. Thank goodness.
So, as Brad mentioned, the Federal Reserve has raised rates aggressively in 2021 and 2022, and their goal was to lower the rapid inflation. In fact, the Federal Reserve chairman said that he would have rather seen a recession than inflation during this time. So that's why he hiked the rates very aggressively. Um, and while we didn't see a recession during this time, we did see a pretty bad bear market in 2022. So the aggressive rate increases led to that nasty bear market in 2022, which also saw the bond markets getting hammered as well. So talk about tough love or taking your medicine, right?
Oh God, no kidding. Yeah. So now that we're out the other side of that, and the Fed has they made their cuts, we went through the nasty bear market of 2022. Let's take a look at where we currently stand. So the Fed started cutting interest rates in 2024. And at the 2024, the December meeting, the Federal Reserve, they lowered interest rates again, another 25 basis points down to 4.25%. So this reflects the Fed's ongoing commitment to achieving its dual goal of maximum employment and price stability. So really, what does that mean for the stock market and your money here?
Yeah, I found this one really interesting. So here, what we're looking at is the forward 1, 3, and 5-year returns of the S&P 500. The first, or when the Fed first cut rates back in 1970. So look at the 5-year number there, all green. Um, a year after the Fed cuts rates, the stock market was up most of the time. The only time the S&P 500 was down substantially a year later occurred during the 1973 bear market, the bursting of the dot-com bubble, and the 2008 financial crisis. It's been rare for stocks to be down 3 years later, and the market has never been down 5 years after an initial rate cut. So sometimes the Fed cuts because we're in or about to be in a recession, but that's not always the case. Average returns have been even better when there's no recessions that occur, but the disparity between the two isn't as large as you might think. So, as we all know, most of the time the stock market goes up, but sometimes it does go down. And the same thing applies for Fed cuts. So, obviously, every rate cut is different. And this time it's going to happen when the stock markets are at an all time high or big gains from the bottom of a bear market during a president election or when Wicked 2 comes out. Brad said that's really good, right?
It's a good movie. I like Wicked. I did. Yeah, the sequel's coming out this year. So
So I'm not sure which rate cuts are. I'm sure that rate cuts matter much more than the stock market right now, considering that the market is a forward-looking mechanism, and they've already priced in things like inflation cooling and the Fed. They're going to cut some rates at some point. So the stock market really cares about earnings. So the economy cooling off or remaining strong likely matters more than a couple of rate cuts by the Fed. So when rate cuts really matter is on your yields that come in your savings accounts or in your money market accounts that you're currently holding cash in.
yeah, yeah. I mean, I think that's a really good point. I love this picture of the kid here because sometimes that's what it feels like. You're like, are rates going up? Are they going down? What's going on? But I think that's a good point, Matt. I mean, you see it on this chart here that the last five, over 5 years later after Fed cuts rates, market tends to respond very well over the
Mhm.
long term. But in the short run, it really doesn't care as much about the interest rates as the media would make you think. Um, Obviously, average returns have been better when there's not been a recession, but the disparity between having a recession or not is not really as big as you think. What the market cares about is earnings. So the economy and companies' earnings is what really drives the market. The rate cuts, I think they matter more for yields on your cash
Mhm.
and
Mhm.
for your cash like securities or maybe getting a mortgage for a home, but less on your stock market investments than you might think.
Well, perfect. That was great. So let's switch gears and let's see what's happening in the housing market.
Yeah, I mean, I don't need to offer any more details on this story because you already know them. Housing prices are up a lot, but so are mortgage rates. So that could be fair warning. I mean, we essentially pulled forward a decade's worth of returns into the first few years of the 2020s. So take a look at this. Here we are. We're 4 years into the 2020s, and the housing market is up 49%. And on an inflation adjusted basis, if you look back at all the decades, you can see there were some decades that actually had a higher percentage return. But when you actually adjust it for inflation, the 2020s have been as strong on an inflation adjusted basis as the 1940s. In other words, we've literally experienced a housing boom in a 4 year period. Okay. So people are asking us, well, where does the housing market go for here? And um, so we see a couple of scenarios. There's one scenario where, yes, the housing market could fall back by 10 to 20%, maybe. We also see a scenario where housing prices could be flat or stagnant for the remainder of this decade here. Um, but regardless of where it goes, I think our base case, what we think is going to happen is that housing prices will probably kind of plunk along at the rate of inflation. We don't see the boom in prices continuing. In a minute here, we'll show you why we also don't see a 10 to 20% crash or correction either. There's data to back that up. So most likely, housing prices kind of plunk along at the inflation rate, maybe 3%. But how you feel about either of those scenarios really kind of depends upon your current situation. In other words, if you own your home and you're going to be in it for the long term, if we go through a 10% housing market correction, it doesn't have a huge impact on you. As long as you can pay the mortgage, you can pay the insurance and the property taxes, life's not going to change in a huge way if your house were to fall by 10 or 15% next year. Um, but the bottom line is, if as long as you can weather that storm, you don't have to move. You're not in a situation where you have to make a change imminently. A decline's not going to hurt you too bad. But we see that as a lower probability event here.
Right. Yeah. And another way to say is that anyone who's had a home for more than the last few years is actually sitting pretty good. The homeowners that would feel the most pain in either of those scenarios are the people that are looking to buy right now.
Right.
And you don't have to look that far back in history to see this play out. I mean, from early 2000 through late 2016, the U.S. housing market the U.S. housing market was underwater from their historical peak until that point.
Yeah, look at that. It
Yeah.
bottomed. So it peaked in '07. It bottomed somewhere after the financial crisis of '08. I mean, really, we didn't hit the bottom till 2012. And then it really rebounded strongly. But shoot, I mean, that's over 10 years of the housing market being underwater, which was a little painful for some.
Right. I mean, prices fell more than one quarter along the way. And more than 6 million new and existing homes were sold in 2007. So plenty of people were actually buying at the top of the housing market back then. And it's even worse in the hottest real estate markets in the country, like Phoenix and Las Vegas from 2006 to 2020 and 2021, respectively.
I mean, that's 14 or 15
Yeah.
years of being underwater from a house price perspective.
Right.
Crazy. Yeah. So here's the interesting thing, and I think this is the case. This is why we don't think we're going to see that 20% housing market pullback. So take a look. This is 1972. The US built nearly 2.4 million new homes in 72, and the population of the country was 200 million. Last year, only 1.4 million new homes were added for a population of 335 million. I mean, realistically, we need to be building at least 2 million new homes a year to keep up with the demand. So we have more people, we have fewer houses being built. And so with higher mortgage rates where they're at today, we don't think that they're going to build the 2 million homes that are needed. So what we think this is going to do is it's going to make for prices to at least remain stable or flat. But we don't see the case for a 10 to 20% correction simply because demand is too strong and supply is not being kept up with it at all. And you look at all the young families that are forming, people getting married, having kids, they're looking for homes to buy, and there's just so the demand is definitely there, but the supply, they're not keeping up with it. So in any case, our family, we consider our house the place to live and call home, raise the kids, and it acts as a good inflation hedge because we've got a fixed rate mortgage, and there's nowhere else to build in Southern California really. So it pays off over time to build that equity, but we don't really look at the house as an investment per se, although over the decades, real estate does tend to be a good investment. We look at an investment portfolio. That's where the investment returns matter. I think a house is really where the investment returns are more of a bonus.
Mhm.
So, so let's turn the page. Let's talk about 2025. Let's talk about kind of where we see prices go. So, U.S. existing home sales. So, some good news. Home sales rose for the second month in a row at the end of last year, climbing about 5.5% roughly in November. Um, we sold about 4 million units last year. This is the highest level in 8 months. So the housing market really kind of went flat for a while because mortgage rates spiked high. But now things are kind of thawing out a little bit, and we're starting to see more activity in the real estate market. So bottom line, prices remain elevated. Supply remains low, and so we think that prices are going to stay relatively flat for a while.
And so we've got some good news with Social Security that for anyone out there that had Social Security reduced by the windfall elimination provision or the government pension offset, congratulations, you all got a raise in January 5th of this year. There was the Social Security Fairness Act that went into place. So this may change the Social Security strategy for some of you out there. And so we're looking forward to crunching the numbers with you and diving deep into your specific situation. So at our next review, we'll make sure to cover that. But one of the things that we just wanted to remind all of you about, and some of you have heard this, but Social Security, the headlines are true in this regard. And I know we say don't pay attention to the headlines. This is another one that I don't necessarily think you need to pay attention to, but I want you to be aware of that the Social Security Trust Fund is going to be bankrupt in 2034. But good news here, there are plenty of ways to solve it. But let's just say that the government does nothing about this whole scenario. About 75, Brad, is that 75% of Social Security benefits would still be able to be paid out. So we think it would be unwise to strip that out of your plan or not plan to have some form of Social Security. It would just be political suicide. So what we wanted to do is just give you a few things. Just know that Social Security is a payroll tax, meaning that if you're the employee, you're paying 6.2% tax into the system, and the employer is paying 6.2 matching that, or if you're self-employed, you're paying both sides of that. And so if they increased that tax, and I know we don't want to increase taxes, but I'm just saying that there's a lot of options out there. So maybe 6.3% tax, that helps solve the issue. Currently, the full retirement age is 67, and so they've pushed this number back to get your full Social Security benefit. So they could always push that number back.
Right.
The earliest you can take Social Security is 62, so maybe they changed that as well. And then one big one is that there is an income cap on Social Security. The number somewhere for this year, and it changes each year, it's about 168,000. And remember how we talked about that 6.2%? So that's only tax on up to that 168,000. All the dollars from the high income earners after that amount aren't being taxed. So if they increase that number or eliminate it, that helps solve the problem as well. And so there's a lot of different spigots that they can turn on and off to help solve the Social Security issue. But what we want to do is that just let you know that it's important to have that Social Security strategy in place. And we love to do this. So let us know if we need to reevaluate the Social Security strategy, and we can help walk you through that as well.
Yeah, you're so right, Matt. There's no way they're going to let the system break down. No politician's going to do that. It'd be the quickest way to get kicked out of office.
Mhm.
Cynically, I think they're going to wait and let it be a crisis. They're going to let it. So, because those solutions that you just named, Matt, none of them are popular. Push
Mhm.
out their full retirement age, raise taxes, raise the income cap. I mean, no one's going to be happy with the solution, but that's what's required to fix this thing. I think they're going to let it become a crisis. And then at the midnight hour, right before we're going bankrupt, they're going to do something that's unpopular and say, oh, well, circumstances made us do it. But at the end of the day, that's the medicine we got to take if we want to solve this thing. And they're not going to let it go bankrupt. So,
Right.
yeah. Well, let's switch gears. Let's talk about a familiar topic that you guys have heard us talk about now for the past couple, 2, 3 years, and it's the dominance of the large U.S. tech companies that are just really doing so well. But now valuations are really sky high. So these U.S. tech companies have dominated the rest of the world here.
Well, take a look. I mean, 6 companies have nearly the same weight as the whole MSCI ACWI index against the next 6 biggest countries combined. It's just wild.
Yeah. Meta, Amazon, Alphabet, those guys are bigger than Switzerland, China, France, Canada, the UK, and Japan. I mean, it's incredible what's happening there with big tech.
Yeah, and I mean the top 10 companies in the S&P 500 now represent 38% of the whole index. And so some people think the concentration of large tech stocks in the US is a real cause for concern, while others may feel that it would be foolish to bet against these biggest, strongest, best corporations that we've ever seen. But let's take a look at both sides of the argument here and then see the concentration among the biggest companies is a sight to behold. So just look how quickly things have even changed from 2015 until today.
Yeah, yeah. And I think this gives you such a good visual represent. You could take a look and see it with your own eyes what we're talking about here. Companies like Apple, Nvidia, Microsoft, Google, Amazon. I mean, they're just massive, massive companies. I love this slide. I think it's so cool how you can see size-wise. This is all 500 companies in the S&P, and you can see the ones that are just ginormous.
Yeah, and then looking at that chart again, I mean, if you are having individual holdings in those big companies, I mean, you could really be running into an over-concentration scenario because you have that exposure within the index already, being 30% of the total there. Like Brad just said, Apple, Nvidia, and Microsoft, Amazon, and Google. But listen to this. I mean, Apple, Nvidia, and Microsoft are all $3 trillion companies. Um,
Crazy.
yeah, Google and Amazon are worth 2 trillion apiece, and Facebook, Tesla, and Broadcom are all in the 4 comma club. So Berkshire Hathaway Hathaway is a stone's throw away from 1 trillion. So these numbers are crazy and just really big. So what goes up must come down at some point, right? So I'm joking about like them being so big that they're could collapse the whole portfolio, but these companies are large, as large as developed nations out there in the stock markets, which is hard to wrap my head around. So investors are worried about the cliche talking points like trees don't grow to the sky and size is the enemy of outperformance and nothing fails like success on Wall Street. Price is what you pay, value is what you get, and yet these companies just keep getting bigger, stronger, and more powerful.
Yeah. Yeah. I mean, take a look at the top 10 companies relative to history. So here we are today. There's the Magnificent Seven. Here we are in the 2020s. And you look back decade by decade, and you can see that we've never, we haven't seen this type of concentration before. Okay. Clearly, you can see it here that these companies now represent such a larger piece of the S&P 500. But here's the interesting thing to consider. We've also never seen companies with profit margins as big as these before either. So these are not the railroad companies of the past or iron smelting industrial companies in the past that required major fixed investment in both plant and equipment. These are technology companies with more efficiency and scale than your grandfather's mega caps. Of course, everyone knows all this by now. You literally would have had to have your head buried in the sand the last decade to not see the fact that these companies have outperformed the market by a wide margin. And that's how they became so big in the first place.
Yeah, and NVIDIA data centers are expected to bring in nearly as much as the capital spending as IBM did in the nifty 50 days of the late 60s, and the network stocks in the dot-com bubble in terms of market share. So this is just wild. And I'm running out of adjectives here, but astonishing, mind-blowing, and astounding, they all come to mind. And you wouldn't believe it, but guess who's spending all of the money on NVIDIA data centers? You guessed it, the other Magnificent Seven stocks. So eventually, the market will require a return on investment from all of the capital investments. The hot stocks of the late 1960s and the early 70s were the Nifty 50 blue chips. Most of you have heard of these, like Coca-Cola, McDonald's, Xerox, Polaroid, and J.C. Penney were all bid up to nosebleed valuation levels before crashing and burning. Some of these names were even down 60 up to 90% from their highs after trading as much as 50 to 70 times their earnings.
That's a great point, Matt. But over the long haul, so those stocks that crashed and burned in the 50s and 60s, like, they did great in the 50s and 60s, crashed and burned in the 70s. But over the long haul, if you held on to those names, owning those stocks worked out just fine for anyone who was willing to hold through the pain. And I think a similar dynamic was at play during the dot com boom of the late 90s and then the ensuing bust in the 2000s. So I think, people were expecting the 90s internet craze to just do wonderful things. And what's I find to me fascinating is that so many of those expectations of the late 90s dot com bubble have actually come to fruition. I mean, think about it. Video on demand, online delivery for food, clothing, household essentials with the push of a button, wireless internet, FaceTime, global social networks, supercomputers that can fit in your pocket, and much more. That's what we were all expecting to happen in the late 90s. Well, it happened. It just took the bursting of the dot com bubble to get there. The NASDAQ crashes 80% and took 15 years to break even because investors set their expectations way too high. So it all happened. It just didn't happen fast enough. So could we see the same thing be playing out today where we're having an AI over investment here where the returns are happening today, but not before investors take things too far and get hurt because they're too excited? Maybe. I mean, that could be what's at play. Um, but I do think the four most dangerous words in investing are this time it's different, meaning,
So, so true.
yeah, I mean, we think that history doesn't repeat itself, but it often rhymes. And so our guidance to you is do not go all in on the Magnificent Seven. We don't recommend that you chase them from here or even own them individually as stocks. There's too much risk. But here's the thing when I say risk, you look at valuations, sky high valuations, right here. But when you look at other asset classes, many of which are fairly valued or even undervalued. And so we think the best way to protect yourself, because you cannot predict the future. Of course, my crystal ball broke 20 years ago, but we think you got to remain diversified to protect against a major market fallout of the big seven tech companies. But that the valuations of the other asset classes here are actually compelling at this point. So, what's an investor to do? You could make a strong case in either direction. Either get the heck out of mega cap stocks now, the valuations are too high and they're due for a mean reversion, or go all in on mega cap because they're the only game in town and they're only going to get bigger, better, and stronger for years ahead when AI rules the world.
And so if since Brad's crystal ball broke 20 years ago, unfortunately mine broke a couple days ago, so we're just a couple days short here. So if you're like us and you can't predict the future, then what's an investor to do, right? Yeah, the answer is you diversify.
Yeah, there's a world of opportunity out there, even though the media just tends to pound the table about the S&P 500 or the big tech. There really is, and the U.S. makes up the largest market share in the world, but there are a lot of other companies or I should say, countries with fantastic companies located there. The U.S. is not the only game in town, and here's what's really interesting to us: major institutions like BlackRock and Vanguard, they are calling for international to outperform the US over the next 10 years. And depending on who you read and listen to, some institutions are calling for international outperformance of 3% per year for the next decade, just based upon where valuations are at relative to history here. So keep that in mind. And again, we're not going all in on anything, but
Mhm.
diversification is so key.
Yeah, and don't let us deter you away from large U.S. companies or the U.S. in general. We love
Right.
investing in the U.S. I mean, if you look at this chart over the last 10 years, the top 10 large U.S. stocks have performed compounding at 15.25% a year. I mean, this is incredible. And all of you that are investing with us, your portfolios have exposure to these large U.S. companies, and you've participated in this growth. But what we're trying to just caution you on is the old saying of trees don't grow to the sky, and it won't continue forever. As much as we wish it did, but that's why we want to have international investing in there too. And we just don't know when the tides are going to turn. So we're not saying that international is doing poorly; it's just not doing as well. And so we just want to make sure we're keeping that balanced approach.
Yeah, absolutely. And I'll call your attention here to the white box. So what you're looking at, far right column, these are 10-year annualized performance numbers of all the major asset classes, and you own most of them in your portfolio. So as Matt said, you have had exposure to big US companies that have absolutely crushed it. In second place for the decade is real estate, up 11.39%. International small is in third place, international core, large value, US small. So you can see the return numbers. And then here's the white box. And what you're looking at is this is a mix of 70% stocks and 30% bonds. So this might be typical of what a retiree may own, something like this. If you're still working and have more than 5 years, you're probably more aggressive. You probably have more stocks. If you're getting older, maybe you have less than that. But this gives it's a good proxy. And what you can see is after a pretty volatile decade, which just saw some wild volatility, saw a pandemic, it saw contentious elections, it saw inflation as bad as we've had in 40 years. This thing compounded at 8.18% per year. And for a retiree, that is fantastic. But what's interesting to note is this white box has cruised along. It's always somewhere in the middle. It's never once in first place and it's never once in last place. And that's exactly what diversification looks like, even though it oftentimes doesn't feel so good. So let's take a trip down memory lane here and let's explore a time period when the S&P 500 actually lagged for a long period of time. And this is the period right after the dot-com bubble. So there's 99, 2000 there on the left, all the way out to 2013. This is a 14-year period where the S&P 500 compounded right here. I'll circle it for you at 4.68% per year. That's less than half of its long-term average for 14 years. That's painful. And yet at the same time, the international investments were red hot. Small caps were red hot. So there was plenty of investments that were doing great. And I'll never forget, it was March of 2009 when the S&P 500 had lost 10% per year right here. So here's the lost decade, 10 years from 2000 to '09. S&P lost 1% per year or 10% total for the decade. Awful. Meanwhile, all these other asset classes, which you own in your portfolio, did fantastic, some doubling, and some quadrupling. So a globally diversified portfolio kept up and kept you through, kept you going, kept you retired during a really rough decade. But I'll never forget March of 2009, S&P hit rock bottom and I literally had phone calls, plenty of them, where people said, "Hey Brad, we're going to sell the S&P 500, right? We're going to ditch this thing. It's dead. It's a dead investment. We want the new money, hot money, emerging markets, international, small cap. That's what smart money's doing. S&P 500's dead." And I said, "No, not because my crystal ball works. I tell you, it broke. It's because that's how this works. Things ebb and they flow." So I'm going to back you up 2 slides. Think about that person. So none of our clients sold the US investments in '09. And thank goodness they didn't, because as Matt pointed out,
Mhm.
look at what the US investments have done over the last 10 years. 15.25%. That's incredible. So again, just illustrating the importance of why we diversify and why it's so important. So
Well, you said something interesting there too, Brad, of that the global invest or the international investments kind of kept up. But I mean, looking at this chart, this is taking a look back on 50 years of returns of a globally diversified portfolio against the S&P 500. And so the data is extremely clear here. A globally diversified portfolio has been the way to go for the last 50 plus years. And we don't anticipate that changing anytime soon. So it's our investment philosophy to be globally diversified, and everyone will be in great shape.
yeah, yeah. So now, we want to explore and kind of talk about what's the impact of the election going to have on the investments. And we know that we need to diversify, but there's a lot of changes going on right now. There's tariffs, there's shrinking of the federal government, which is causing uncertainty. And if the market doesn't like anything, it does not like uncertainty.
Yeah, I mean, the market has been volatile this year. Here's a look at the max drawdowns by presidential terms going all the way back to Teddy Roosevelt. And some of the years are worse than others, but it's hard to pinpoint any kind of relationship between the presidents and the stock market's downturns. So I'm pretty confident that we'll have some big corrections or a bear market at some point in the future, maybe the next 4 years or so. But I find it hard to believe that the president has a lot to do with the stock market going down. The stock market just the volatility happens because of the uncertainty.
Yeah, it does. And same with recessions. This is a look at the recessions going all the way back to 1901. And they have, and you can see the political party and you can see the recession and a lot of randomness here. And yet the market has been pretty resilient despite the amount of recessions that we've had over the last 120 years.
Mhm. Yeah, and a lot of you have seen this one as well, but as a reminder, it's a good reminder that the market has done quite well under a variety of presidents. So you can see going from bottom left, the market has an upward trend, whether it's red or blue during those time frames.
Yeah. And I think this one here really kind of illustrates the fact that I think people tend to think that the political party or the president has more impact on the markets. This to me is so insightful. So I'm going to compare and contrast President Obama to President Trump, and this is Trump 1.0 here. And we're going to look at the top performing asset classes for each president. And the ironic thing, you couldn't find two presidents with more diametrically opposed political philosophy and agendas here. And yet, look at the top three performing sectors for Obama and Trump. They were the same. They were the same, which is just wild. And then you look at Trump, very pro energy. What was the worst performing asset class under Trump? Energy. Energy was the worst, right? So then you get President Biden, green and clean, very pro environment. You'd think energy would be terrible. It was President Biden's top performing sector. I mean, it's just wild. So I think it goes to show you that the markets and the economy are far bigger than one person and one party. And I guess in many ways that's good. That's a good thing. But yet we do tend to get so caught up around it, and really quite we can feel those emotions, which then of course causes the volatility. That's not fun. So yeah, Matt, you mentioned we've had a volatile start to the year. Markets are up actually, but it's been volatile. It has been up and down.
Yeah, I mean, well, let's look at all the asset class returns in 2024. Everything was positive. In fact, only one exception, everything has been positive over the last 5 years. And then all of the returns for the last 10 and 20 years have been positive. So why are we even talking about market volatility?
Right? I mean, good point. Everything's been green for so long.
Right. But I mean, volatility is the price you have to pay for those wonderful long-term returns. I mean, let's take a look at this chart here, and it shows you that in most years, the stock market ends up in positive territory. So that's good, right? But every single year, we have to be okay and accept that the market's going to take a dip or a dive at some point throughout the year. So during those market dives, it's tempting to hit the panic button or make a change. But remember, we want to be rebalancing through the markets. And like Brad showed earlier on the different asset classes, we want to be selling the one that's doing good in real time and purchasing the
Right.
one that's doing bad in real time. And that's, buying low and selling high in real time as markets move so quickly.
Right. Right. And just kind of setting expectations around what should you expect for volatility. So 94% of all years, so pretty much every year, you should just expect to watch your investments be down by at least 5%. 64% of the time, that's nearly two-thirds of all years, you should just expect a 10% decline in your investments. That's
Oh, that
normal.
doesn't feel good.
No, it's painful. Well, I love what you say, Matt. Volatility is the price you pay for the wonderful long-term returns. It's so true. I mean, 26% of the time, that's nearly 1 in 4 years, the market's down 20% or more. So very, very painful in situations like that.
So, Brad, you mentioned earlier that the markets don't repeat themselves, but they often rhyme. So, I
Right.
wanted to put this in here that we can see there have been many black swan events in history that we saw 30% drops in the markets, such as the interest rates rising above 9%, or Black Monday when the Dow Jones was down 22% in a single day, or the dot-com bubble of the early 2000s, and then the global pandemic. And so we know these things are never fun and they are unprecedented at the time, but it doesn't mean that you should hit that panic button, like I said,
Right.
because the markets have recovered and hit new highs since each one of these different events. And so, I mean, we never know what's going to be the trigger or anything, but that's what we're here to do to help coach and empower to make sure that we're not making any of those big mistakes. So we're sure something new is going to be the cause of a big drop in
Right.
the future. We're just not sure when that's going to be. All we can say is that it makes a lot of sense to stay invested during all of these times, as painful as it can be. So, Brad, if you
Yeah.
could show us why this is important.
Yeah. Yes. And as I've said before a minute ago, the four most dangerous words in investing are this time it's different. And Matt, you make such a great point. These black swan events that all happen, think about it. This was really the first time in history that we've seen any of these events. I
Mm,
mean, the housing bubble was just nasty. We thought there was going to be a global financial crisis. That Black Monday being down 22%, very, very scary. And
mhm.
so this time it's different. It's very easy to latch on to, well, this time it's different. This time things are not going to recover. This time it's going to be different. And the reason why it's important not to panic, not to react, not to sell. This is a 30-year time period here where the market's compounded at nearly 10% per year over 30 years. But the investor who reacted and flinched and got nervous and sold and missed just the single best day in a 30-year period had their returns cut down by almost 0.5% per year over 30 years. The investor who missed the best 5 days in a 30-year period had their returns slashed by 1.5% per year. And pity the person who missed the 25 best days in a 30-year period. So that's having one bad day a year where you just got emotional and you reacted. Your returns were slashed nearly in half. So that's the reason not to hit that panic button is if you do, oftentimes, most of the time, you're going to swing and miss. And when you do, that's what could derail your retirement, essentially. And that's what we're here to try to prevent.
Absolutely.
So yeah, I mean it's tough. We recognize that investing does take intestinal fortitude. It takes discipline. I mean, that's why Matt and I are here in your life. We are the insurance policy against doing anything foolish. So that's a part of what we want to provide to you as we partner with you on your journey. But with that, we want to turn the page now and start to talk about the things that might impact us in 2025. And I wanted to start with a couple major headlines here. Okay. So there are definitely some things to be concerned about. Valuations are stretched. What's the Fed going to do? Europe seems to be dead. There's wars in the Middle East and the Russian Ukraine conflict. Market forecasters are predicting poor future returns. But here's what you're going to find surprising: every single one of those concerns was from 2014.
I see what you did there.
I mean, these headlines could have just as easily been published today. And that's my point. These are 10 years old. It's all recycled material, which is why I think President Harry Truman, that's what he was getting at when he said, the only new thing in the world is the history that you don't know. But I mean, it's crazy how eerily similar 10 years ago the headlines were to what people are thinking and feeling today. But nonetheless, you've asked us all for our opinions.
This is
And
my
so,
favorite part, so
yeah,
everyone turn up your speakers.
I'm telling you, that crystal ball broke. But since you asked, we're going to give you our predictions for 2025. So clearly, a lot of people are going to be unhappy with the economy regardless of what happens. When inflation's too low, people are complaining that wages are stagnating. When inflation's too high, people are saying that, oh, wage and growth are too high, right? So, savers were complaining years ago and they're getting crushed by low rates. And now, they're complaining because we have too high of interest rates. So always, always somebody is going to be unhappy. We predict that one.
Yeah, and if you own more than one asset class, security, or investment strategy, you're bound to be unhappy with the something in your portfolio. Going back to that Skittles chart, never going to be in first place, never going to be in last place. And so the old saying is that diversification means that you're always having to say you're sorry. So Brad and I apologize ahead of time for the diversified portfolio. But
Yeah.
it would be nice, if your stocks, bonds, cash, real estate, or other alternative investments would go nuts and all grow at the same time. But chances are something's going to perform poorly, even if 2025 is a strong year like the last two. So if you're properly diversified, you shouldn't expect everything in your portfolio to be firing on all cylinders. Again, some will be ebbing when the others ebb and flow. So diversification is only working in the long term if some of your investments aren't working. And so this is by design, and you're all set up for success.
Yeah, absolutely. So the eighth prediction, number eight, top 10, number eight, your favorite influencer is not going to make you rich overnight. Some of the same people who are preaching to you about being zen with your finances and finding your enough, those very same people are obsessing over how much money they make, and they've got an unhealthy relationship with money. So most of the folks who seem to have life figured out on social media are totally full of it. Don't pay attention. Prediction number seven, you probably won't predict the timing of the next market correction. And one of my favorite Warren Buffett anecdotes comes from his quarterly letter in the 1960s when one of his clients calls him up to warn him that stocks had further to fall. They were already in correction territory and they called and say, "Hey, Warren, stocks are going to fall further." And he goes, here's his response. If you knew in February that the Dow was going to collapse in May, why didn't you tell me back in February? And if you didn't know what was going to happen in February, back then, what makes you think you know now? So I'm fairly confident that at some point the stock market is due for a correction, but I'm not confident in my ability or anyone's ability to predict the timing or the magnitude of that correction. So preparation is easier than predictions. Again, diversification, rebalancing, asset location are the keys. All right, number six, the Lakers are not going to win the NBA Finals. I'm sorry, LeBron. I'm just saying it's not going to happen. I predict that. You heard it here first. And again, Glenn Close, number five, Glenn Close is not going to win an Oscar. That's another prediction. And by the way, did you know that Peter O'Toole and Glenn Close jointly hold the record for the most Oscar nominations without a win? Sorry. Number four, I definitely am not going skydiving with Matt Callahan. That scares me.
But I got to let you know, there's more and more people, even some on the call tonight, that are doing it. I'm getting photos, so it's not as dangerous as we think.
All right. So if you go skydiving this year, send Callahan your picture. I want to see it too. Send us your pictures. We love seeing that stuff. All right. Number three, you probably will not predict the best performing stock this year. Not going to happen. All right. So let's take a look at the top five performers in 2024 and show you how difficult it would have been to predict these ones. We had Genedex Holdings up 2,740%. We had Rigetti Computing up 1,630%. Sezzle, that's right, Sezzle Inc. up 1,190%. Dave Inc. up 1,070%. And SoundHound up 1,030%. Look, I follow the stock market pretty closely, but I'm not ashamed to admit that I've never heard of any of these companies.
Yeah, me
And
either.
no, I mean, the only way I'm going to own one of these best performers is in my total stock market index in the portfolio that all of us own. So it takes the guesswork out of it. But there's, I think, the likelihood of anyone in our audience picking the top performers very low. Number two, emotions will run sky high, whether that's greed and feeling good about things and buying too much at the top, or fear and selling and at the bottom. The average investor tends to buy high and sell low and run by those emotions of fear and greed. And we're not sure which emotions you're going to feel this year, but you're going to feel something for sure.
Mhm.
And number one, our top prediction is that the stock market will not give us average returns. So long-term return of the market still right around 10% per year. And as we shared with you before, it's so difficult. You can only see there's only been a couple of years that have been even remotely close to giving you 10%. So we had a 10.81 and a 10.74, but every other year has been way above that or way below that,
Mhm.
sometimes making us feel exuberant over here, leading to irrational behavior, or sometimes making us feel downright depressed and scared over here. But that's how the wonderful long-term averages of the stock markets get put in, is through the high highs and the low lows. You just have to be patient and diversify and rebalance through it. So that's our top prediction for the year.
I
Um,
think you
so,
nailed it. I'm in 100% agreement that all of those are going to happen.
hey, did we go 10 for 10 this year?
Yeah.
I think the big one last year was the Chargers will not win the Super Bowl. They just hired Jim Harbaugh, although the Chargers did do much better this year than last year. I don't know. Notice we took that off the board. So does that mean the Chargers do have a chance this year, Matt?
You're saying there's a chance, yeah.
All right. So, in conclusion, definitely get social with us, please. Subscribe to the YouTube channel. We're putting out really good content that's going to empower you, educate you, and make you a better investor and just better equipped to get through this season of life. Follow us on LinkedIn. Follow us on Instagram and Facebook, and we definitely want to connect with you. So, here's to a successful 2025. It is such a pleasure to work with you, and it's just an honor. Matt and I love it. Our whole team loves it. We're growing thanks to your referrals. We appreciate that. We're hiring. We continue to grow. So everything's good, and we just really love working with you guys. So
Yeah,
thank you.
thank you.
Yeah. So with that, we're going to open it up for questions. And if you have a question, feel free to put it in the chat bar. Oh, Harry's saying, "Fear not, go Chargers." I like it, Harry. Not the Cowboys, huh? All right, home team. Okay, so here's a question,
Mm.
and so the question is: we started talking about inflation. Does inflation affect volatility in the market? How does rising inflation help or hurt our portfolios? That's a great question.
So I'll start if you want to piggyback on it, Brad. But inflation. So one of the things we talked about the uncertainty in the markets, and that can cause volatility. So if inflation is causing uncertainty, then there could be more ups and downs. But what we want to do is have enough stock in the portfolio, because that has been the number one thing over and over, and proven to not only beat inflation but keep your purchasing power strong. So just one landmine that we want to make sure that we don't run into is getting too conservative too soon in your portfolios.
Yeah, absolutely. I think the inflation. So what's interesting to that one is the response to inflation, and rightfully so, was raising interest rates, and not just raising interest rates, but jacking them up fast.
Mhm.
And so what you saw, so that the impact, the not so subtle impact, happened in the bond market too. So there's this inverse relationship, and excuse my crude drawings, but You've got price, well, this is in the bond market, prices, and you've got interest rates. Okay. And there's this inverse relationship. So as the Fed raised interest rates, think of a teeter totter. Okay. Fed raises interest rates. Well, prices come down. It's an inverse relationship. And that's exactly what happened. And that's why in 2022 is a really unusual time where not only did the stock market go down, but the bond market went down because rates went up and they went up quickly. And so what did we do to protect against that? Well, we didn't, again, no one can predict the future. We did this years and years ago. We put a castle, we put a moat around your investments. All of your bonds were very short term. They were some of them slightly considered medium term, but mostly short term bonds for protection. So your bonds held up really well during that. It was literally a bloodbath in 2022 because of rising interest rates. Fortunately, your bonds held up pretty well. The price to pay for that security, though, is the short term bonds don't yield as much as the long term bonds typically, although we have had an inverted yield curve for some time. So that could be changing at some point. But a really good question, and I hope that was helpful. Um, okay, here's a question. Okay, Harry's asking, how might the elimination of income tax and replacing with tariffs for government income play out for investors? Good question. Um, so if you eliminate income, so I think there's two things going on there. If you eliminate income tax, I think that consumers are going to have more money to spend. So
Mhm,
I think one half of the equation is people are going to be spending more, which I think is going to be strong for the economy, and not just the U.S. economy, but the global economy. I mean, think about the goods that all of us consume. Most of them, many of them, are not made in the U.S. anymore. So if we're spending money, it's definitely going to benefit companies, not
mhm,
just at home, but all around the world. It'll be interesting if they do a full elimination of income tax and a replacement with tariffs. I think at some point the tariffs, if they get too onerous, we could start having trade wars, and that could be a potential challenge. But the increased consumer spending on goods and services could perhaps offset that. Personally, I don't think we're going to have a full elimination of income taxes and a full replacement with tariffs, but in theory, I think that would be be interesting to see what happens. I don't think it's going to play out that way. Um,
yeah, I agree with you, Brad, that so inflation will increase. But what we saw is if inflation increases and then we see tariffs, this is actually very similar to what we saw in the 70s. And a globally diversified portfolio actually did quite well during that time if we end up seeing that. I don't see the elimination of income taxes going that direction, but I mean, we always have to be aware of what may come.
yeah,
I would encourage everyone, if you haven't already, like Brad said, with the YouTube channel. If you do have a question and you're not wanting to ask here, a lot of the questions will and can be answered on the YouTube channel, and we're open to suggestions on topics. So feel free to throw those our way as well.
absolutely. We are having so much fun putting out educational material on YouTube. So if you want to see detailed breakdowns of any subject, feel free to email us. And we've got a running list of things that we're shooting. So um, hope you find it helpful, and so great to see and connect with all of you guys. And it's just a pleasure to be part of your journey. So we look forward
And
to seeing you soon.
yeah, thank you all. And I'm making one more prediction for 2026 is that my camera will work and I will be there.
Yes, yes. And housekeeping, make sure to send us your tax returns. Upload your tax returns to the vault as soon as you get them. We want to get into tax planning mode here no later than June. So upload the tax returns. Also, we are having a wind down the tax season event as we always do, April 24th. It's a Thursday. Bring in your tax return. It's a shred event. Bring in your shred. We're going to provide wine, beer, snacks. I'd love to see you in person. It'd be so nice to see you. So mark the calendar for Thursday, April 24th. And also, backed by popular demand, we are going to host a pickleball event. It's was it the first, I think August first Friday in August, Matt? Is that the first,
Yeah, let me confirm.
July 31st?
Yeah.
But that was a smashing success last year. So love to see all of you guys there, and hope to see you in April at the Wind Down the Tax Season event. Bring your shred. People show up with boxes of shred. That's what it's for. We got a truck coming in. So love to see you guys. And
And
once again,
the
yep,
date was actually, August 1st, so that Friday and, later this year, first sec
bring your pickleball. Bring
yeah,
that pickleball game. Yeah. All right, you guys. Well, thanks for everything, and have a wonderful evening. And we look forward to seeing you soon.
yeah. Thanks again.
Bye, guys.
Alright,
Bye
bye-bye.
bye.